I'll say good afternoon and welcome to everyone for joining our first landlord webinar of 2023. For those that don't know me, I'm Clarke. I'm the Lettings and Property Management Director at Nock Deighton, with over 30 years experience in Shropshire and Worcestershire lettings market. The topic of today's webinar is finance, and I'm joined by just one guest speaker, who is Ryan Garbett from Private Finance. Before I introduce Ryan properly and hand you over, I just wanted to give you a very brief update on recent legislation. In 2020, we had the electrical safety regulations, which require all domestic rented properties to have an electrical installation condition report every 5 years. And also then in 2022, we had the smoke and carbon monoxide alarm regulations, which required all rented properties to have a smoke alarm on each floor and a carbon monoxide alarm in every room with a combustion appliance. So that updated the regulations, I think, which originally came out in 2015. And the main part there is to do with the CO alarms, because before you only needed one in rooms with solid fuel appliances, so now it's all combustion appliances. Then also last year we had the sort of introduction of the Renters Reform Bill, which hasn't come into force yet, but the white paper was released. That is going to really be the biggest change in legislation probably since the Housing Act 1988. I'm not going to go into detail about that today. We did do quite a big webinar on that last year, which was recorded. So if anybody that is here or watching afterwards that wants to know a little bit more about the proposed changes under that Renters Reform Bill, then just email me separately and I can send you a link to the recording. The other legislation is the which came into force 3 days ago on the 23rd of January, which is the Fire Safety England Regulations 2022. Oh, my screen is wobbling again. Please ignore that. I hope you can hear me. Can you still hear me, Ryan?
Yeah, yes, yeah.
That's okay. So I do apologise. It's technicalities here with Zoom, I'm afraid. So yes, it's the aim of that legislation is to prevent further tragedies such as the Grenfell Tower fire from occurring, and it applies to all non-domestic premises in England and Wales, but it also includes non-domestic parts of multi-occupied residential buildings, such as sort of blocks of flats and the internal areas, the communal areas of those flats, as well as houses converted to 2 flats or into HMOs. So the fire safety order requires a responsible person to undertake and review regularly a fire risk assessment of the building and maintain precautions that manage the risk of fire. So back to our next topic. Having our main topic, I should say, having experienced huge changes in the housing market on both sales and lettings over the last 2 years, and the hikes in inflation and interest rates, not to mention the energy crisis and, of course, the infamous mini budget, it's understandable that some landlords and investors are uncertain at the moment of whether to buy, sell or stick in 2023 and going forward. So Ryan is an experienced independent financial advisor who specialises in commercial and buy-to-let mortgages and financing. I hope Ryan won't mind me telling you that he's also a landlord, which makes it easier for him to see things from a landlord's perspective. All those attending the live webinar today will have the opportunity to ask Ryan questions by adding these in the Q&A box at the bottom of your screen. And I'll read these out at the end of Ryan's presentation. And so, Ryan, hello.
Hello, hi.
What is your view of the current buy-to-let market?
Look, it's challenging. I don't think you can be you can't sugarcoat it. It is challenging, but there is certainly lots of opportunity where there's unfortunately where there's there's problems, i.e. inflation, interest rates, you're going to have landlords that dispose and you're going to have vendors under pressure. And that creates opportunity. And what we'll discuss today, I'll go through where the current market's at, what it looks like, what the landscape looks like, how banks are accommodating buy-to-let in the best possible way, and really looking at solutions on how to retain, how to keep profit, how to stay profitable, and ultimately help people make an informed decision rather than buy what's in the press. I think that's kind of the press sells and newspapers sell and the news is on just really from a negativity point of view. There's never nothing that's positive, and because that doesn't sell. So the biggest thing in an environment that we're in at the moment is take stock, relax, take a breather, and be calculated. Don't get sucked into all of the negativity, because that sells. And look, I'm in the same position as the vast majority of your landlords. We're having to make decisions on what we do, what interest rates we go for, how long we're going to keep that property, and it's all about planning. Property is still the most valuable asset. You can see it, you can touch it, you can feel it, you can drive past it every day knowing that it's there. It's a really strong asset, visual asset, unlike other investments where it's in stocks and shares. You're not in control of it to a degree. With property, you are. You can make decisions on how long you're going to fix your rate for, on what rent you can charge, on how long you're going to sign the tenancy agreement up for. There's loads of things that you're in control with property, unlike so many other investments where you're not in control. So it'll be quite structured. So we'll go through where the market's at, some of the pitfalls at the moment, some of the hype that you're seeing, look at some of the opportunity, and more importantly, how you can retain, like you said before, look at how you can make it slightly more profitable or sell. Look, finance is a huge part of buy-to-lets, huge part. There aren't many landlords that are sat on unencumbered properties. A lot of the time, or historically, it just wasn't tax efficient to have a buy-to-let property with no debt. Now it's pushing the mortgage side of things to reduce your debt slightly, perhaps. But and again, we'll go through this in a slightly more structured way. But where I see the property market and the buy-to-let market, look, it's challenging, but still huge opportunity, still ways that you can make money, whether it be just short-term from the income side of things or long-term capital growth. But my job here is to give informed advice, give the facts, and from today you should go away and have food for thought. I think that's the biggest thing, and then we can have really detailed conversations from that.
Great, thank you. Have you got a presentation?
I have. So let me just share my screen. 1 second. If I click here, should in a minute load up. Okay, can you see that?
Yeah, that's great, thank you.
Brilliant. Okay, so we've just mentioned there, what does the landscape look like? Certainly challenging, but there's opportunity at the same time, so take a bit of a breather. We'll go through, first of all, the buy-to-let market update. And look, there's no question there's been significant changes over the last 5 months from an interest rate perspective. It started slightly before the mini budget, because inflation was kind of off the scale and going through the roof. So the only way that the Bank of England can control inflation is by increasing interest rates. If you imagine you increase the interest rates, it gives people less money to spend in the economy day to day. So it means that people can't go and buy a loaf of bread at £1.80. So it forces the shops to bring down prices for people to be able to afford it. So when interest rates increase, it's actually to control inflation. Yep. So that's where we're sat at this moment in time. The mini budget was a disaster because it just panicked the markets in full. Everybody panicked because Liz Truss and Kwasi Kwarteng scared the financial markets, and all of a sudden, not the Bank of England base rate, something called swaps rates shot through the roof, and that affected buy-to-let lending, which we'll come on to in a few moments. So look, despite these changes, the negative press and the facts around interest rates increasing, the buy-to-let market, the private rented sector, is still the backbone of the UK economy. And there'll be some questions raised within government and the banks and as landlords, really, how they keep that being the backbone of Britain. If the property market isn't ticking over, People aren't having windows fitted, they're not having new electrics, they're not having heating systems put in, they're not having new insulation. All of the other jobs that are associated to property actually start to suffer as well. So the Bank of England and the government will be keeping one eye on what's happening with the property market. I think a lot of the time it's almost like fake news to calm things down. So to a degree, it sounds very Donald Trump of me about fake news, but that's the reality. Some of it is fake to just calm things down slightly, or create the hype to on the other side of it to get rid of property, to get rid of landlords, from that side of it. So, and it's taking stock of that and just taking a bit of a breather. So I mentioned there the PRS sector, private rented sector, is the backbone of the property market. There's actually still huge demand to grow that. So you can see here, 227,000 homes a year are needed for the next decade. So imagine interest rates keep increasing, the tax keeps getting worse, the energy performance certificates, they're putting more and more pressure on that. It is pushing landlords away. So there will be a change. There'll have to be a change at some stage, which always happens in government, to go, actually, we need to take a look at this. It's not really working out how we planned. And that's where a case of sometimes you've just got to ride the storm a little bit, I think, and go, well, actually, where is it heading before making a decision based in the panic? And that's where we're at this moment in time, the sheer panic. So look, from a positive point of view, rates are still available at 3.74%, but they're just not advertised with the likes of Santander and NatWest, your high street banks. So the rates where they're 3.74% are different types of lenders, smaller regional building societies, private banks. So there are still really, really good deals available. We had this warped perception of what interest rates actually were for a 10-year period, which really a generation of landlords have had interest rates at 1.5% and 2%. Buy-to-let still worked in 2007, if you remember, and you bought your properties at that stage. Interest rates were at 5.5%, and property prices were incredibly high, incredibly overinflated. And there was a crash beyond that, but actually those buy-to-let landlords, a lot of them just rode it through. Then came into a really decent period in about 2013 when interest rates started to get really attractive. Yep. Because despite the Bank of England base rate dropping down to 0.5% in 2008, that wasn't passed on to landlords immediately. It wasn't really until about 2013 that you started seeing the interest rates get really attractive when there was something called quantitative easing put into the market. So we've been here before. What's changed is the tax side of things, which we'll come on to in a few moments. Lenders are being smarter and smarter with criteria where they can to get things to work. Banks have to lend money to be able to make profit. So again, you're seeing banks pulling out of the market. They're not supporting buy-to-let landlords. They are, it's just in different forms. Banks are also being more creative to accommodate these changes, so the EPC changes, for landlords to buy rundown properties, accommodating a one transaction where you buy a rundown property, they help you pay for the refurb, and then they give you the mortgage on exit. There's some really, really cool products out there that accommodate landlords who are looking to grow a portfolio or get into the market. A big change which has happened is personal name. So what used to happen with buy-to-let mortgages, you could get a buy-to-let mortgage in your personal name at 2%, but if you were to get it through a limited company, it was 4.5%, 5%. Now they've come in line. So now personal name and limited company lending is almost on par. So that gives you a kind of a whistle-stop tour of where the buy-to-let market's at this moment in time. So yes, there have been significant changes. I don't think you can be blasé about that. Everything changes. It's how you adapt to change, and we'll go through that in a few moments. So what are the challenges facing landlords? And I think this is the big one that we'll have a lot of questions around, is the increase in interest rates, no doubt reduces your profit. And this is where you've got to make a sensible decision to say, well, actually, if I'm making less profit, am I benefiting from capital growth? So do I hold on to the property because actually this area is going to improve over a period of time and it might rise in value by 20% over the next 5 years? So actually I'm quite comfortable making a 3% profit, for example, or 10% profit, whatever you're looking at, return on your investment, you might have gone down from being 5% to 3% as a result of the change in interest rates. But you know what? This property hasn't really hit its full potential in terms of value yet. So if I hold on to it for a period of time, ride the storm and look at it and go, well, actually, this is benefiting from capital growth as well. So not am I just benefiting from the return on investment in the short term, and forgive the pun, washing its face, wiping its nose. Actually, I've got the benefit of potential long-term capital growth, because there's a new shopping centre being done in the area, or the high streets are being regenerated, or Taylor Wimpey are building a site up the road. You know, a number of things like that will improve, or schools going in the area. Yep. So another big thing which is changing, the way that lenders assess affordability. Naturally, if interest rates are going up, lenders can't offer the same level of borrowing for properties. We're quite fortunate in the West Midlands and this part of the world that actually buy-to-lets generally stack up. If you go south of kind of Birmingham and heading down towards London, buy-to-lets haven't stacked up for about 10, 15 years. So we're quite fortunate here that they still stack up. But the way that lenders assess affordability has changed drastically. Started to change actually back in 2016, and that comes on to the next point, when Section 24 was introduced, because lenders had to make sure that not only had you got enough profit to make it worthwhile doing, but also enough profit to pay the tax with the tax changes. So lenders factor that in when they're doing their affordability assessments. And this is known as ICR stress testing, interest cover ratio stress testing. Yep. And really basic, because I don't want to dwell on it too much. But for example, ICR stress testing at the start of last year, if it were in your personal name, was 4.5% at 145%. Sounds like jargon, but it will make sense in a few moments. ICR stress testing now is at 5.5% at 145% in your personal name. So what that means is if the rent was £500 a month, yeah, £500 a month times 12, divided by 4.5%, divided by 145%. So February last year, if you had £500 a month rent coming in, you could get a mortgage based on that stress test alone of £91,000. Yeah. We do the same calculation today. So 500 times 12 divided by 5.5% divided by 145%. Today, with that £500 a month, you could get a mortgage of £75,000. Yeah. So you can see the impact on the interest rates going up on what it has on the loan size. And that will actually put pressure on house prices. Because if you're going out to negotiate with someone on a property that it is a standard buy-to-let, and a lot of the time the vendors know that that property is going to sell to a buy-to-let landlord, your negotiating power is actually, I can only offer this because it only stacks up on this basis. So that will put pressure on house prices for new and acquiring landlords, because when you're going out to negotiate, you know what you can offer on the property based on the ICR stress test I've just mentioned there. Yeah. So those 2 points there, the lenders changing the way they assess affordability, and the Finance Act with Section 24 going hand in hand. Other challenges, house price over the last 2 years actually forced a lot of landlords out. You didn't see many landlords buying for the last 2 years. 40% of our business at Private Finance is buy-to-let business, but that might be remortgages, that might be purchases. But actually the purchase business from a landlord perspective, we didn't see a lot over the last 2 years. Do you know why? Most of my buy-to-let landlords that I speak to say, I'm going to wait. There's going to be a bit of a crash following this. The bubble's going to burst. So that's where the opportunity is. People who are overgeared, people who are suffering from inflation, people who don't need the second home that they bought in Iron Bridge or whatever as a holiday home, they'll be willing to sell at the right price because they understand that the property increased up to 20% over the last 2 years, and they've decided to sell. And that, by the way, will be one of the challenges that you face as a landlord. If you're selling and you're selling it to a buyer, they're going to raise exactly the same question. I can only get it to work on this basis. Another big challenge on the horizon, the EPC changes. And this is where you can be one step ahead. And this is where it is good to look at the finance side of things now, because actually you can start to improve your buy-to-let properties at this stage, add value to them, increase rents, look at it as a HMO, look at how you can get the best return on investment from it. So whilst if a property becomes vacant, and this is my job as well, is to look at the finance to go, actually, let's be one step ahead of this. Let's talk about EPC changes. Why don't we do the work now the property's empty, add the value and look at being able to increase the rent where you can? Because if it's more energy efficient, if someone's got to pay £25 a month more, £50 a month more on rent, but you've made it more energy efficient now, and it's going to save them more than that in bills, great. I've hashtagged this at the bottom to say, this is all in the press. You see all of this. So this is just something I wanted to highlight. So what's the opportunity? We mentioned there, landlords disposing, flooding the market because of the press that you're seeing. If 10 people go and put their house on the market in one particular area in Telford, which is renowned for landlords buying, and they've all panicked, they've not done the calculations, they've not looked at it. Well, guess what? One person sells their house at 115, it brings the house price that somebody put on at 130 down. This is one of the biggest issues for landlords disposing all at the same time, is actually there is no question that it will force house prices down. It's different to residential properties when they're a 4-bed detached on a particular estate and it's a family home. That's bought with emotion. That's bought with touchy-feely. They like the garden, they like the block paving. Don't you think that window looks nice? That is a different type of purchase. So they're prepared to pay £30,000 over what it's actually worth because it's touchy, it's feely. Landlords traditionally have bought a certain type of property that sells to landlords, and that arguably will push house prices down. So there's an opportunity there. A lot of frustrated vendors, they probably put their house on the market at the wrong value. A lot of estate agents were massively overvaluing because they're bad. When I say it's bad estate agents were doing that. Good estate agents will come to the market now when it gets really difficult, giving the right advice. So there's going to be a lot of frustrated vendors that actually, if they bought at the right time, this is where it's kind of frustrating. We see it quite a lot. House prices, you kind of have gone up so ridiculously high in such a short period, it's fake money. So if they've gone up 20% over a 2-year period and prepared to accept 10% less, they're still 10% up on where they were 2 years ago. So that's another opportunity. There's still an incredibly steady demand for tenants, for basically tenants, people wanting to move. And that will only get better for landlords who are acquiring as a result of landlords disposing, because there's going to be a period when a lot of properties are having to be bought with vacant possession. That means tenants panic for a period, and then that means you've got more and more tenants who are looking. Increasing rents as a result of lack of stock. So it's horrible to see rents keep increasing because it doesn't seem quite fair. But the reality is it's the supply and demand side of things. Opportunity, I mentioned before, there's lots of creative finance out there. Banks are trying really, really hard to get money out of the door. The difference between now and 2008, 9, 10, there's lots of money in the economy. Don't be fooled. Lots of money in the economy. In 2008, 9, 10, you remember people going to the cash points to draw money out at Northern Rock. Banks had no money. There was nothing there. It gone. Banks were going bust. We've had a really, really amazing, 15 years since then, 12, 13 years since then, where banks have got themselves their balance books right. They are profitable. They've been really sensible with the way that they stress test. They haven't been giving people too much money. So they're in a position at the moment where they're really strong, and there's still plenty of cash kicking around. And the opportunity for you, I think this is the big opportunity for particular new ones. We'll discuss existing landlords in a few moments. You're coming into a market now where the pitfalls. Dawn picked on at the very start, of what needs to be in place to make a property fit for purpose, fit to be let. That. Section 21, Section 24, buying with a limited company seems to be a more suitable route than buying in personal name. We know what interest rates are like. Banks are stress testing if interest rates are much higher than they are. So you're coming into the market now with a clear view on actually what it looks like. So there's the opportunity. What to do next? So I'm planning for success. Well, and again, we'll go through all kind of the interest rate side of things in a few moments when I'm sure with the question and answers. But for me, it's not to panic. Don't panic. Look at when your deals are coming to an end, your mortgage deals, and start looking at them 6 months, 12 months before. We can look certainly 6 months before and even secure deals 6 months before. And you know what? If rates get better, we look at it again. We just keep a constant eye on it. You can lock in your deal 6 months before your existing deal comes to an end. So it might be you say, actually, interest rates are pretty good at the moment. I think they're going to go a bit higher. Let's lock it in now so we've got it ready just in case. And if interest rates drop, great, we just renegotiate at that stage before you've drawn down. Look at the facts. So sit back and look at your portfolio properly and see where you're making money, where you're losing money. If there's a property in the portfolio that hemorrhages money all the time, it's an old property, it's always got a leaky roof, leaky taps, and they're the properties you go, well, do you know what, we'll dispose of that. And that will be a new opportunity for another landlord who can add value to it and bring it back to the market because there's products out there to do it. So it's taking a balanced view on it. Consider your long-term strategy. This for me is so important. Portfolio landlords have traditionally worked on interest only, so skimming off the top. So if you've got a portfolio of 10 and you were making £300 over and above the mortgage payments on an interest only basis, great, you've benefited from cash flow. It may be that you change your strategy now and go, do you know what? It's not really working on this basis, skimming off the top now. I think I might consider capital and interest. And no, park that portfolio, know that that portfolio doesn't make me any money, but the debt's coming down on a monthly basis. And it's actually in 20 years' time, that mortgage is going to be paid for. And at that stage, I can make a decision. So I've worked it every day, just that's my day job, that was my money. And now I've changed my mindset to go, that's a long-term investment. It's not making any money. I have to pay a little bit of tax towards it at the end of the year. But I know in 20 years, those properties are going to be paid for outright. And I've got 3 properties that are all paid for, and they're bringing me £700 in each a month, and it's a great pension. One of the issues, if you decide to dispose of it now, you'll think in a few years' time, I shouldn't have sold that. I shouldn't have sold it, because now I've just blown the £30,000 equity I got from selling it. I've been and bought a new car. I bought some new windows in my house. And I've got nothing to show for it. So again, what I'm saying there is just don't panic, relax, look at it, look at the opportunity and think about your plan. And that's where we'll speak to you. So at Private Finance here, we'll speak to you and go through actually, what's it look like on interest only if you model it? What's it look like on capital interest, and talk through what your long-term plans are. A big thing here as well. So when I'm saying relax, it's not for me to get immediate business and, you know, Nock Deighton thinking, oh God, my portfolio is going to disappear. It's kind of factual to a degree. It sounds good. I have to be loose, careful what I say, they're factual. But if you look at something called SONIA swaps rates, and that's what specialist lenders trade off. So when you get off the call here, if you look at something called SONIA swaps rates, following the mini budget, they went up to about 5.5%. And that basically meant that all of the buy-to-let lenders that trade off something called SONIA swaps rates meant that they couldn't buy debt in for a 5-year deal any less than 5.5%. That meant they couldn't be selling a buy-to-let mortgage for any less than 5.5%. So it'd be 6%, 6.5%. A SONIA swaps rate today is sitting about 3.57%. That's not in the press, which is crazy because they've come down by nearly 3% since that money budget. That means banks now can afford to buy money in at 3.57%. What a SONIA swap is, so if you look at a SONIA swap over the next 2 years, so a SONIA swap over 5 years is coming in at 3.5%. A 2-year SONIA swap is actually considerably higher. So that suggests that the banks feel the next 2 years are going to be turbulent, And beyond that, they think it's going to be okay because they're prepared to buy money at 3.57% for 5 years, yet for 2 years, it's a lot more expensive, which suggests the market's going to be difficult for a 2-year period. And then beyond that, it might get a little bit better. Plan again, looking at your portfolio. So we've touched on it, improve if they become vacant, add, look at increasing the EPC at this stage, looking at releasing a little bit of equity from your portfolio to tidy it all up. If you're not getting the best return on it, consider HMOs. HMOs has always been a bit of a dirty word really in this part of the world. You think of HMOs and thinking, well, actually, does it work? We haven't really got universities. We haven't really got, we haven't got a city life where there's loads of people who are living and need cheaper accommodation. There's a huge demand for lower end accommodation at this moment in time because people can't afford to be first time buyers, can't afford to get onto the property market. They don't have the deposits. They probably can't afford to be paying £600, £650 plus bills for a 2-bed or a 1-bed flat. So they're starting to consider, how do I get out of my parents' house? What's the next step for me? Young professionals with great jobs. So it might be worth you looking at some of your properties and going, actually, that would really lead itself. It's got good parking outside. The bedrooms are quite big. Why don't I convert that onto a HMO? Looking at how we refinance, restructure your portfolio. So can we balance the debt? So if you've got one property that's particularly highly geared and another one that's got no debt on, how do we balance that out? I put here as well, incorporate. So there's lots of tax advisors, accountants that are giving all different advice. And if I'm honest, it's quite confusing around how to incorporate. And it's worth touching base with your own tax advisor. One of the guys here, Mike Perrin in the London office, has just incorporated a guy's portfolio of 30 units. They're taking it from personal name into limited company. And because they were transferring over personal name to limited company, there were already some tax benefits by doing that, multi-dwelling relief and so on and so forth. One of the big things here, which is worth sitting with the accountant and going through, actually, is it worth paying the tax? Because if I pay the tax to incorporate it and it's short-term paying now to pay the tax, but actually in the long term, I can write off all my interest as a tax deductible cost in limited company. The interest rates now are similar to what they were in my personal name. It might be a case that you go, I might swallow the tax and incorporate, because if I incorporate, it's more tax efficient anyway. Because if I sell in the current climate and I have to take a £15,000 hit on the price, I might as well pay the £6,000 to put it into a limited company, for example. Yep. So I was kind of a bit of waffle there on my view of the market. And I know that I haven't touched drastically on interest rates, but that's all relevant depending on your own circumstances. But the reality is, my big thing here is to go, just relax. It is more difficult. There is no question it's more difficult. When you call in, you'll find that it's taken us, rather than going straight away, 24 hours, we've got indicative terms out to you. It's taken us now a couple of days to look at it all, to see who we can place your business with, see how your background portfolio checks work. So just be, but that's our job. And then present the credible options back to you and say, does this work for you? And you can make an informed decision. So look, Dawn will go through questions now. Of course, I have to caveat at any time when you've taken a mortgage, all of your you put it as a security, so there's always a risk of repossession. It's kind of doesn't finish it very well, but it wouldn't be compliant if I didn't do that. So hopefully that's been helpful. I'll stop sharing my screen now, and then feel free to pick our brains. We've got quite a large team here, so whilst I'm one of the brokers in our Shrewsbury office, there's between me and my colleagues in London, there's about 45, 50 of us that are all kind of more than familiar with this market. So we'll be able to go through it. And like I said, this type of finance takes more time now. It used to just be back of a flag packet, you go online and you get a deal. Now we just have to go through the structures and how it all works. Dawn, has that been helpful?
That has been really, really helpful, very enlightening and quite fascinating, really, just to think of the, the different options that people might have really, without, but just before making a decision, that they just sort of consider and sit down and consider their options, and obviously to speak to someone like yourself and your colleagues at Private Finance as well, just to see what what options there are there. That doesn't hurt anyone to have a chat, does it? And just to make sure that they've looked at all their options and with regards to sort of planning ahead. I do have some questions in here. I've got 4 questions to ask. The first question is from David. Our portfolio sits around 30% loan to value, certainly not over leveraged, all held in personal name. What I'm finding is that the lender's fees are pushing £4,000 to £5,000 in some cases, plus the broker's fees. Would you advise using your cash pile, which I intended to buy with? Would you use that to clear all the buy-to-let mortgages?
Look, when you're geared at that level, there's still some tax benefits. You still get your 20% relief. There's no question you'll be a higher rate taxpayer there. So you've still got some tax advantages of it. Regarding the fees and the fee side of things, the reason why, and that just jumps back slightly to where the SONIA swaps were, lenders had to try and find a way for it to fit on ICR stress testing. So what they did was move how they made their money from the interest rate over to the arrangement fee. That started to calm down a little bit now. So at one stage, David, Paragon Bank had a 5-year fix with a 5% arrangement fee, which is ludicrous. It's ludicrous, and it didn't work on lower value properties for sure, but it worked on London properties. And people were prepared to say, well, actually, if you blend it at 1% over the 5-year fee, it puts the rate up slightly. I think there's benefits to having debt. And again, it's always worth speaking to your tax advisor. The benefits are things like IHT, inheritance tax, if you've got a debt there, whereas if it's all unencumbered, all you've done is increase your net asset position. So sometimes the benefit of having some debt there, it's quite morbid. I don't know how old you are, but the benefit of having debt, bearing in mind buy-to-let lending can go to age 100, it actually improves your tax position from an IHT point of view, not capital gains, but IHT. Again, pick that up with your tax advisor. Cash is king in an environment that we're in. Whilst you might be paying on your portfolio 5%, for example, when it's on the debt that you've got, when it's balanced across the portfolio, actually that's not too bad. If you pay that off, you've only got to pay to refinance at some stage if you see another property, because you might be a bit short on cash. Cash is king in the environment that we're coming into. I'd like to look at those mortgages. You're absolutely right. Arrangement fees are quite punchy, but they are coming down because I mentioned there the SONIA swaps rates have come down quite a lot just recently over the past 3-4 weeks. So that has changed lenders' position in terms of those extortionate arrangement fees. It was only the extortionate arrangement fees weren't with a lot of you. They were with the specialist lenders, i.e. Paragon, Fleet, Foundation Home Loans, the lenders that were buying their money from the swaps market, and they could only make it work by charging those arrangement fees, because of course those arrangement fees were their profit, because if they were buying debt at 6% and were having to sell it out at 6.25%, they were making such a small margin. The way that they got it to work was put it on the interest rate, put it on the arrangement fee. Hopefully that answers, but I feel free to answer another question if that doesn't quite answer it.
No, that's great, thank you. James has asked, you mentioned that buying via a limited company is possibly a good idea. What about when a portfolio is already established in personal names? Is it worth setting up a company for future purchases and then running 2 parallel portfolios? It didn't seem sensible to sell existing properties to a limited company and incur the stamp duty and other costs when the idea hit the headlines a few years ago.
Yeah, definitely. There was questions for a period of time around that, James, when you were buying in for me anyway, I use me as a perfect example. A lot of our properties are in our personal name, and then the ones that we started to do moving forward are in limited company. And the reason why I was inclined to keep them in my personal name for a period of time anyway, it didn't make financial sense of transferring them, not only from the CGT and the stamp duty point of view, but actually from the interest rate point of view. I could get an interest rate in my personal name at 2%, rather than paying it at the time. A limited company was 4.5%, 5%. Now they're in parallel. So anything that we buy moving forward, if we dispose of one, for example, then I'll buy the next one in the limited company, because the interest is a tax deductible cost. With limited company lending, it's going off in a bit of a tangent and not really my area, but the benefit of limited company is you leave the money in there as retained profits, for example. So when it's in your personal name, you're taxed at source. So at the end of the year, you do your tax return and you pay your 40% or whatever it is. In limited company, you pay your corporation tax and you can have 20%, and you leave your money in the company and let it build up, for example, to go and buy your next one. Or you've created a directed loan account by the money that you put in there originally to acquire properties, and you could take that back for the first so many years, being again tax efficient. So previously, yes, I would have been saying potentially, is it worth buying a limited company, because the interest rates are so low here that actually, whilst you're getting the tax benefits of the limited company, the interest rate's so much higher. So cash flow wise, it didn't really make too much difference, but now it makes a significant amount of difference.
Did you, we were speaking about this again the other day, about avoiding capital gains tax? Is there like a sort of two-stage process that some people can do when they're moving it across to a limited company?
Yeah, look, I'm massively uncomfortable speaking about it, and I'll tell you for what. It's because Graham Loosely, the guy that you work with, Mercy Accountants, that's something that he's discussed previously, about having a partnership and then incorporating the partnership into limited company. And it's an area that is quite grey. There is benefits of doing it, and different advisors, tax advisors, give different opinions on it. So we were sat with a guy called Sean Randall at Blick Rothenberg last week, and Sean was like, in theory, it could be done, but then our HMRC going to kind of go, is that the correct transaction? But you're right, there are accountants out there and tax advisors out there saying you can go from your personal name to partnership, and then incorporate the partnership into limited company and not pay the incorporation. You get incorporation relief. But it's for me, it's a bit of a sticky wicket, and that is where someone like Graham, that's where they make their money. Basically, they're advising on what you can do. My accountant personally, we set up a partnership about 4 years ago, and we started to do it, and then I've had different advice from other people, and they're like, well, it's a bit of a grey area. So that's definitely one for the accountant. But there are people that are adamant that you can go from personal name to partnership, then incorporate to limited company, and there's huge tax advantages to doing it. I'd say get some advice there, because certainly your mortgages would have to change, because your mortgage would be going from personal name over to limited company.
Right, okay, well, thank you for answering that, and if anybody does want to know more, I can pass details over for Graham Loosely too, who will obviously advise more on that one. But that's very interesting. Yes. David has said be interested to know what the cost was to transfer from own name to company name, so I think that's probably being covered. Sadly, there are a few companies out there offering dubious ways to transfer from own company. There we go. Yes, so I think you've covered that one, Ryan. Thank you. James said this question is related to a very low geared personal name portfolio, so that was the other question. Okay. David, even as recently as yesterday, still being quoted very high fees with TMW, etc. So high street-ish in the buy-to-let world. So TMW are part of Nationwide, they're like the subsidiary. They've been going about 30 years. They're arguably the biggest buy-to-let lender. So this isn't just selling my wares here, but
what you find is a lot of brokers are something on a panel. So let's say like Open Work or something similar, and we're something called directly authorized. That means every single lender you can imagine we get to deal with. So the mortgage works are very vanilla. You know, they're kind of mortgage works, Birmingham Midshires, Coventry Building Society. You go on a sourcing system and it comes up with a list of the lenders that do it. So I've just done a mortgage with a really small regional building society at 3.99%, with a £999 arrangement fee. And this is something to consider at the moment. And do you look at variable rates? So not trackers or not fixed. Do you consider a variable rate or a discount variable rate with a building society? Because they're funded completely differently to high street banks. So a smaller regional building society are funded by their savers. So they're in a position at this moment in time to be able to offer debt cheaper than people who are buying their money off the swap market or people who have had their money from Bank of England initially. So some of the value actually at the moment, depending on your circumstance, of course, is actually with the small regional building societies. So that lender there that we deal with, we're one of only 4 brokerages in the whole country that get to use them, because they're too small to be able to work with people like Mortgage Advice Bureau, Open Work. You know, they're a small regional building society, and that's where there's value.
Yeah, that makes sense. Okay, I don't think I've got any more questions that have come in since then. So that's it, and we've almost covered, or we've done 50 minutes altogether, but that has been really, really useful, and I hope those that have sort of tuned in, I know not everyone can tune in today. We had over 80 people that have registered for this webinar, knowing that if they can't watch it live, they will get a copy of the recording. So we'll be sending the recording out to everyone that's registered, including those that are here today, to watch again if they need to. But it's just, I think it's very topical at the moment. You know, we did a survey with all of our landlords a couple of weeks ago, just sort of asking, you know, what are your future plans? And most are sort of coming back, you know, with varying, you know, I'm not sure, or I'm going to sell, or I'm going to sell one, or whatever. And so it is very topical at the moment, really. And people are wondering because their finances are changing. And we're also finding that, you know, landlords that bought in the 90s are deciding now to retire, and they want to sort of downsize as well, or again have come to the end of their mortgages, and so they're ready to sell. So we are finding that there's a lot of sort of landlords are selling properties, but at the same time we're getting new investors still coming into the market saying, you know, right, okay, I want to invest in property, what can I do? And so it is very changing times at the moment. And I think anybody that is watching this will have found your presentation extremely interesting, just to see that there are so many options and they need to consider. And obviously just want to say to everybody that you know, we will share Ryan's contact details at the end of this when we're sending out the recording. So anyone that wants to contact Ryan directly, I know you, Ryan, will be happy to sit and have a chat and set up a meeting with anyone to just to discuss initially what options they may have, and there's no charge for that, and to give quotes if needs be. So I'd like to say thank you to everyone who's watching and who's watching the recording. I hope you've got a lot out of this webinar today, and we will continue to do these webinars. We also did a couple of live landlord conferences last year, which those who came to those will know Ryan as well, because he was there giving us a presentation. So if anybody's got any topics that they want to see on these webinars or at the next live landlord conference, which should be in March, we'll release further details of that as soon as we've got confirmation of everything. But please email me directly with any topics that you want to speak about. I know EPCs are certainly very topical at the moment with all the proposed changes. We don't know exactly what they're going to be yet, but they're saying obviously it needs to be a C rating from 2025. But anything like that, any topics at all, then just let me know, and we will make sure we get the right speakers giving the presentations as well. And thank you again, Ryan, for your time today. And yeah, we'll pass the details on. Thank you everybody for watching today. I will stop recording now